All right, so learning objective 3 really takes a look at cost of goods sold and how financial statements for manufacturers are prepared. Okay, and so you're going to take a look at this, and it'll be different from what you had in financial accounting because the categories, the accounts are going to be a little bit different, but everything else is going to look very familiar. An income statement is an income statement. It's going to show you revenues minus all your costs, giving you a net profit. It's just manufacturers have a little bit more to think about here. Okay. So both manufacturer and merchandiser have a cost of goods sold section, but as you'll see, it's just slightly a bit different. Okay. For a merchandiser, and this is from your financial accounting, the cost of goods sold was always your beginning inventory plus your cost of goods that you purchased to bring into the store for sale. Then after a period, you looked at what you had left and the rest you sold, so it was your cost of goods sold. For a manufacturer, again, they're the ones who are making the product. So what they start with is what finished goods are there in inventory. So remember, a finished good is when that process of raw materials and direct labor and all that factory work spits out at the end something ready for sale. Okay. So it goes literally, as I would say before, from a tree and just a stack of wood to these beautiful tables and chairs at the very end. That's a finished good. Okay. So we look at for a manufacturer the beginning amount of finished goods we have in inventory. We add to that all of the cost of goods that we have manufactured. And then we subtract from that the ending balance in finished goods. That difference is cost of goods sold for a manufacturer, and that's what you're going to be seeing and focusing on in this part. Okay, so here is what cost of goods sold looks like on an income statement. Manufacturing is on the right, a regular retailer, merchandising company is on the left. So here for an income statement, your cost of goods sold is your beginning inventory plus your cost of good purchased, right? That's all the goods you have available for sale. You subtract out inventory that you had at the end of the year or end of the period, and that's your cost of goods sold. However, for a manufacturer, they use slightly different accounts, as you see here, but the process is very similar. They start with finished goods at the beginning of the period. They add all of the manufactured cost of goods sold that we're going to look at in the next illustration. That gives them all the cost of good available for sale. They subtract out what they have left in finished goods, and the rest is cost of goods sold. Okay, so very similar, but of course different accounts, but a very similar approach from what you saw way back in, believe it or not, it was way back in chapter 5 in your financial accounting class. So this is what it's going to look like. Remember, your total manufacturing costs are your direct materials plus your direct labor plus that manufacturing overhead. So you already saw that in the chart in the last objective. So that's your total manufacturing costs. So that's important to know. You are, however, going to have what we call work in progress or work in process, sorry. So this, again, between that stack of wood and the finished product, which is a nice table and chairs already painted and shellacked or whatever they do with them, right, to make them shiny. There are goods, there are products that are going through the process of going from a piece of wood to a beautiful table and chairs. So that is the work in process. That's the work in process, right? So for your snowboard, it's a snowboard that's not done yet. You're in the middle of making it, but it's not quite done yet. That's a work in progress. So total work in process here, we take the cost of that beginning work in process, and we look at the manufacturing costs, which we talked about here. So this is how it works. To get the cost of good manufactured, it's a little bit of a formula here, but it's not bad. You take the beginning work in process inventory, the stuff you're working on right now. You add to it the total manufacturing costs, right? That's your labor, materials, and overhead. That's going to give you the total cost of the work in process. You take that total cost of the work in process, subtract out the ending work in process inventory, and that's going to give you your cost of goods that have been manufactured. So this is illustration 8 in your book and in your notes, and this is something you're going to need to refer to calculate this. But as you see, it's simple addition and subtraction. You just got to make sure you're picking up the right numbers here. Okay. So how does it all work in the scheme of things here? Well, this is illustration 1.9. If you have your book, it's page 14 in your book, and you can see the process how it's done. So cost of good manufacturer schedule for this company, current designs, for the year, okay, that ended December 31st, 2017. So they first start off with what was the work in process at the beginning of the period as of January the 1st, 2017. Well, it looks like they had $18,400 worth of work in process inventory. Okay, terrific. Now, the first thing they do is they look at all the direct materials that they have used. So they started with a certain amount of direct materials and inventory at the beginning of the year. They certainly added to that by purchasing more direct material. And so they have a total amount of direct material listed here for use. At the end of the period, they looked at how much raw material was left in inventory, which was the 22,000, which means they actually used the difference. So this 146,400 is simply the difference between how much raw material was available for the year and how much is there at the end of the year. Okay, 146,400. Then they take the direct labor, which is going to be very simple. In this case, they're going to be giving it to you at some point in the future. We will be calculating more detail on that. And then they're going to be adding up all of the manufacturing overhead, the indirect labor for the products, factory repair, factory utility, factory depreciation, factory insurance. Lots of factories there. Okay. Adding all that up, there's your total overhead. When you add your direct materials that have been used with your direct labor, with your manufacturing overhead, that's your total manufacturing costs, $376,800. So if you had $18,400 as your beginning work in process, and you have total manufacturing costs of $376,800, your total work in process is the two numbers added together, 395,200. Those two numbers added together. Then at the end of the period, right, you looked around to see, okay, what's work in process right now? How much do we have? Well, it looks like we have only 25,200 of work in process. Well, the difference is the cost of our manufacturing that year. So the cost of good manufacture is the difference between everything you spent on the cost of work in process less what's left for work in process. That's the difference. So even though you might not necessarily need to create a big table like this, this might be a smaller table to do, more simplified. This process is important to study, okay? Because it's going to tell us again that cost of goods manufactured. This is something that you have to know about, at least how to access this. Again, it's an open resource course. That's the wonderful part about it, I expect you to be using your book or your notes or illustrations or whatever you print out at home. But always have these samples in front of you so you can follow what we're doing. And so we come to the end of Do It 3, right? Learning Objective 3. So speaking of a smaller schedule, this is what they're asking you to do. This is information for Keystone Company, and it shows the difference, well, starting on March 1st versus March 31st. So here you have raw material inventory. At the beginning of March, it was 12,000. At the end of March, it was 10,000. You have work in process inventory. At the beginning of March, it was 2,500. At the end of March, it was 4,000. You have materials that have been purchased in March, direct labor in March, and your manufacturing overhead in March. Okay, so they want you to look at that cost of good manufacturer schedule that we just looked at earlier to put all these numbers and make sense of them. And what you have here, of course, is you start with your work in process for March. You're going to be adding in the raw materials for March 1st, plus what you bought, minus what you have left. So you actually used up 92,000 of raw materials. Direct labor, they give you the number, no calculation. Manufacturing overhead, they gave you the number, no calculation. So you have materials, labor, and overhead. Total manufacturing cost, 387. So in this sense, we had started with 2,500 a work in process. We manufactured 387,000 more. So 389.5. We looked around. We only have 4,000 left in work in process. The rest is going to be cost of good manufactured, 385.5. So this is something that you're going to have to, again, look at for your homework as well. Questions on Objective 3?